Well, welcome to the Edge webinar. Number of people joined. Quite exciting. We are in the unenviable position of just transitioning the website to something new, brighter, and better. So if you do go to our website, you're probably get a sign to say, we're no longer there. But fear not. Hopefully that's back up by the end of the day, if not sooner. And you can check in with us and see a bit more. But I think the aim of today really is to give you an insight into how we look at a space where it remains a great pool of value if you invest in stocks, and we call it hidden opportunities because they are hidden. Frequently now. There's enough FOMO in the market really to chase stuff that runs away, and we all feel we need to get on it. The next Nvidia, the next Tesla, the next AI, quantum, whatever it is. But you know what? Longer term, we become winners. Certainly, our clients have become winners by looking in areas where others don't, and those areas are just what you see up there: spins. Also known as special situations, but we'll come to the distinction between those in a second, and also activist ideas. So if you're a fund manager out there, you definitely got a strategy. We understand that, but this is something for you to consider, and we'll go through that in a minute. So just there's the case, right? You could fit into any of those. You'd be a growth guy, you'd be a value guy, you'd be a dividend income guy. Whatever strategy it is, let's face it, you want stocks to move, whether they go up, whether you're long short, whether they want to go down. And really, it depends on a number of factors. But frequently I run into fund managers, and we've been around for close to 18 years now. Founded the firm in, can't even remember, 2007, something like that, maybe just slightly before that. But run into a number of fund managers. They say, Jim, we don't do spin-offs. We don't do special situations. Well, my answer to that is, do you like stocks to move or to go up? Of course we do, Jim. Well, hold on. Let me give you an idea. The reason that stock will move is because of this situation. So, you can easily dismiss this because there's a lot of work involved in spins and special situations because by default, they're complicated. And we do a lot of that work really for our clients. Well, that's what we do. We do that work for clients to play them up with enough good ideas. So today, we're not really selling you ideas. We're selling you this process. The process will get you to the ideas. And, every fund manager and everyone on this list today will say to me, Jim, we do our own work. Well, of course you do. You should do. You should validate what we do. And frequently, you'll see stuff that we don't. And that's a good thing. But the actual idea, the pool of where it's from, you're never really going to see it. So, who am I? I've been around for a long, long time, about 30, 35 years in investing. And our company, like I say, we look for good ideas. It's as simple as that. Good ideas that you won't see. The street don't cover them. They're too hard for any sort of machine to follow, and there's still a massive disconnect in there where if you look hard enough and analyze correctly, you will find great value. Okay, so just give you a quick overview. We'll last about an hour. You don't have to spend for an hour, but there's going to be a Q&A session at the side. Now, if you've got any Q&As, put them in the chat. Doesn't matter at any point. And I'll endeavour to answer those right at the end and answer any questions. So just put them in the chat there. Your chat should be open to you. So today, what we're going to look at, general current market challenges. We're going to show you our approach gets to those mispriced opportunities. And like I say, we're a firm seller of the process today. We do not manage money. We look for good ideas. So along with this, we're looking to focus on mispriced outcomes, spin-offs and special situations, distinction. Not much of distinction really. Spin-offs are special situations in effect, but spin-offs for me have kind of their own asset class in the way we analyze them. We have a certain way of doing that. and just share how we do it. Because if anything today, you can take away some of this and you can say, well, you know what, Jim, I don't need your help. We can do it ourselves. But frequently, what we've seen is a lack of resources out there, and focus on stuff that requires, great labor intensity and analyst power. So we're a complement to your team. We're not replacing your team. People get afraid, Jim, I do all this. Yeah, we do all this. But, maybe you do, maybe you don't. But, if we can give you a hand in it, or we can point you in a different direction, or we can even do it for you, why not? So we're going to give you some highlights of some upcoming opportunities next year, and some real case studies of stuff that you may have missed, because again, people come to me, Jim, I know that spin-off, it done really well. Well, maybe it's not about the spin-off either. Maybe it's about the parent. There's two sides to a spin-off. So, I'm going to give you a lot of things to ponder today, and you can check in. Paul will follow up afterwards with you. But if you like any of this stuff today and you think it could be useful in your investment case and your process, then come back to us. We'll love to have a chat. All right, so current shape of the market, we just go up. There's no buying the dip anymore. We just go up, right? We just go up, and we just go up on a few stocks. And the argument is, well, I don't need your help. I don't need anyone's help. I'm just going to invest passively. Well, passive is a different argument, and there's pitfalls to that too. But certainly the big stocks are moving the index. We all know that. And most of us probably won't even take positions in those big stocks. So we're looking at an area that, your portfolio should be 20 to 25 to 30% of it involved in this area of the market, which are just uncorrelated. And, they're uncorrelated to the wider market. They'll perform over, our 25-year study. John will go into this afterwards. Our 25-year study indicates that special situations and spins perform over any type of market, up, down, because they're very, very independent. They're price catalyst driven. And that's very important to remember. So if you're looking for something to diversify and stuff to sell to your investors, this is an area which is just going to perform. Providing you get the right idea. So remember that. So you don't have to chase the market. And really the idea of chasing the market for me is a bit outdated. We're not chasing the market here. We're looking to gain great returns of a process that works over time and to make people money. So where do we find these mispricings? And you're gonna see some stocks here that are going to be maybe you've seen, and you're certainly going to know, but maybe you've seen the spin-off or breakup gone through. So if you don't know what a spin-off is, and sometimes I assume people know, and sometimes it just takes a bit of clarification. It's where a company will break up into one or two or more businesses, and with that, it's going to create many, many dynamics. It could be new management. It will certainly be new management. It could be new debt allocation. It could be new cash flows. It could be a totally separate business, re-rating. There's so many things at work. And this is why they're so disconnected, because, when a breakup occurs, it creates all these weird, like I say, dynamics. So just, I'm assuming you know what a spin-off is. If not, have a quick read up, but certainly the dynamics underneath it is the stuff that, we really drill down. But on the left there, you'll see some stocks pop up. Of course, you're going to know Honeywell. Of course, you're going to know Spinoff, Garrett Motion, Residio. One very interesting one where, the spin-off at the time, or the spin-offs at the time, weren't that good. Honeywell, if I recall, dumped about $1 billion of debt onto the spin-off. They nearly went bankrupt. I think maybe even Garrett came out of bankruptcy because of that. And they've not done all right since. But the dynamics of this one was the parent was the good company. So it wasn't necessarily the spin-off. So something to remember. And we got case studies. There's GE, you probably know, front page. I was on the front page of Barron's talking about this. One of the greatest spins breakups. Certainly where a company is in total distress and they need to. And I don't know if you noticed recently, we've been pushing Boeing down at 140 to our clients. really on a similar breakup. A similar breakup needs to happen in Boeing. That stock's now at 167. Though we didn't get what we wanted, we still believe it's a possibility there. But on a margin of safety basis, it's very, very cheap. The same as GE. That wasn't so miraculous. The stock was cheap. It needed to be sorted out, and the three breakups were huge. I mean, if any of you had any of those stocks in your portfolio, you didn't need much else. And that was a big cap spin. And these are all big names you're going to recognize. Kellogg's is another one. Kellanova, fantastic. I think it's just got taken over. Siemens. These are all stocks that you're gonna know and love. But did you get into them? Were you alerted of the spin-off? Did you even invest in them? Did you even understand what was going on? And my suggestion is you probably didn't, because you didn't get told. And that's really part of our job. And mostly our job here at the Edge, to really plate up these ideas and say, you know what, this is coming up. This is how the dynamic's going to work. This is what we think. Whether you believe what we think is something else, but the fact that we can play up those ideas through our process is going to put you, in 20% of the fund managers out there. So there's a lot of reasons for mispricing, and some of you are going to know this stuff, and some of you are going to be more familiar than others. But they're all doing it for a reason, and and this is what I'm going to go back to. Kind of our secrets, really, or one of our secrets is, you've got to find out what the reason is of the breakup. Why are they doing it? You've got to assume that the main reason for the breakup is to create some sort of value creation. Now, okay, I get it. It's a little bit blanket, a little bit generic. So then we drill down. Okay, where is it? Where is it? Is it unlocking shareholder value? What else is there? John, just flick these up as I go. Focus on the core business. And at the edge here, we've got to find out, that reason. We start with the reason. Too many analysts go out there and they say, well, you know what, it's going to create this. This is the sum of the parts. 2 + 2 = 5. We get it. But you know what? You got to drill that back a little bit more. You got to find out, where is it that the company, because they're telling you frequently, the company will tell you what is the reason for the spin. And most analysts, and I say most analysts, will miss it. They will miss it. They'll jump to something else because they want to show their skills in adding up numbers. But all these reasons down here are the reasons why, where we go as a company to find out, what is the reason for the spin-off, and then we go from there. Whether we believe that reason or not, and what underlies it is our analyst skill. But that's where you got to start. So again, you take one thing away from here today, there's one for you as well. Take that as our experience, but we'll do that work for you essentially, and we'll find out. So you can see all these names here, and this is available, this presentation, if you check in as well to us, and we can give that to you. Okay, so the challenge of finding mispriced opportunities, and this is something that is more and more prevalent in today's market, because the street or the research world really just doesn't cover it. If you're a fund manager, you're going to look at yourself, say to yourself, I ain't getting anything from spins from my broker. I know that for a fact. Brokers cannot analyze what we do or what the spins are, and essentially what we do underneath that. So there's huge coverage gaps in this spin-off space, and John will take you through on how many are going through, but there's a number of them which you're just not going to see. I mean, GE, yeah. I mean, all those companies, but how many of you know yourselves? Ask yourself that question. Did you know they're going for a spin? Were you on top of it? Were you able to say yes or no to it? I suggest no. And even on the screens, say, okay, Jim, we've got our screening session. We can run down Bloomberg with our own screens. We spot all these. Well, no. The spin-offs, particularly the dynamics, won't feed into any sort of screens really, and certainly not Bloomberg for a long, long time. And a lot of these opportunities in our study can be very, very early on. You're a growth investor. You want a good stock early on. This is a place to find. You want a value. These things can become very cheap. All those strategies that we mentioned earlier, these will fit into that criteria. And again, they're very, very complex. We've got one coming up for Vivendi. Vivendi, if you're an international guy, split into 4 pieces. Have you done the analysis? I suspect not. Do you know what's going on? I don't know. So, if we can play up a number of those ideas through the years for you, or through the year, and give you the opportunity to invest in those, why wouldn't you want to do that? So this is so these, a frequent question. Well, Jim, I know about spin-offs. I think they're great. They create alpha. Well, yes and no. John would take you through it. A lot of these fail. A lot of the spin-offs are just duds. If you think you're going to buy every spin-off and make money, just please don't. But the good thing is there's a huge pool and it's a great hunting ground. If I go into the hills and know there's gold there and I know where to dig it, then and I'm pointing you to where to dig it, that's a great start. So they can go from growth to value, like I say, all over the place, really. You're looking for good investments at the end of the day. As you well know, investors, you know, and I shouldn't really say this, they don't really care when you produce the returns at the end of the year. They're going to say, well, did that come for a spin-off? They just care about the number. And this is a great source of value creation and alpha. Sectors, all over the sectors, up and down market caps. We don't go too small. $1 billion is apparent, is the smallest we go. And if you're global, great place to look. So here you can see the volume. There's a decent amount of volume that goes through in these, and there's enough for you to chew on and get one idea a year. If that's the worst scenario. Best scenario getting 35 plus that 70 companies. So like it says there, large cap, mid cap, small cap, all over the place. So a great pool that unless you got some sort of fantastic screening, you will not find them. All right, so why should you even care what we're saying? Well, you want to make money, and we want to make money for our clients. We're passionate about finding those ideas, and nothing gives me more pleasure in clients making a return on our ideas. Yeah, Jim, we'll use that. Fantastic, well done. What's the next one? It's always what's the next one? What's else coming up? Give me the next one. Well, we get it. We're just very careful. My perception of the world is, we've got to manage the risk first. What are the bad ones? That's my question. What are the bad ones coming up? I don't want to give you those. I want to quantify the risk, and there's no downside, just like Boeing, big company Boeing, who quantified the risk. It was extremely cheap. Special situation, extremely cheap, special situation at 139, probably the low, or thereabouts the low. I didn't believe there's any more downside. We got clients into it on a sum of the parts basis. Sum of the parts puts that double. That's your margin of safety right there. So I was confident in pushing that to clients. A lot of clients got in. 20% later in 2 weeks. Thanks very much. It doesn't have to break. If it breaks up, you got even more, and that thing keeps going. So like I say, we're giving the best ideas. We're managing the risk. There's a difference. We manage risk first, and then if the risk quantifies the idea, then it caps your downside. So that's what we really do at the edge here. We're going to play up those ideas with a risk management push first. Okay, I'm going to keep pushing on it because John wants to come on. So our process, what is it? We're looking for good ideas with an edge. Our name, with an edge. That's why we create the firm, to say, you know what, there's plenty of ideas out there, but what's the edge? What is the edge in the situation? Is it behavioral? Is it analytical? Is it something else? What is it? What are we seeing that the market doesn't? And that's important for any investor to go, whatever investment you put in, am I just going with the crowd, or do I see something that the market doesn't? And if you do, you got something. So we're looking for spin-offs. We're looking for all the filings. We're analyzing those filings. We're finding out, the regular trading that when issued. We're keeping you in touch. We're pushing a full analysis. We're looking to fundamentals, technicals, and insiders. Insiders is a great one. It's almost another webinar. And we'll give you our insights, and we'll plate these up before the event happens. So you have plenty of time to say, you know what, we needed a bit of work, or Jim and the team, can you find out this for us? We have a team of analysts. So, that's really what we do in that process. And even on special situations, what is a special situation? Coming back for the distinction we had before, is, spin-offs. Yes, they're special situations, but there's a number of other areas we look at, and they can be insider dealing. We have 40 years of insider dealing, insider trades. Not all insiders know the way the stock going. A lot of them are just value buyers. They can be buying their stock all the way down and essentially just being value people. But the catalyst people is where you want to look. There's the clue. They know an event's going to happen. Turnarounds, management changes, demutualizations, also known as privatizations, and definitely falling spins. Stuff that orphan securities that people have forgotten about. Great source of value. So if you, again, another snippet for you to take away today, don't look anything else, go hunting there. But we do that a lot for you, and we can play up the good ones. Okay, so what do you want? I mean, what as a fund manager, what do you want? I'd say from the bottom up, really, on that. Avoid losing deals. Don't give me the bad ones. Don't burn me on the bad ones. This is a great source of value. It's a great hunting ground, but there are bad ones. Now, if you can avoid the bad ones, right, then the upside will take care of itself. And that's what we try to do. So they generate significant alpha, if you like that word. And I still like that word. No reason why we can't. Why you want to create stuff above the index. You want to be different. You want to show your expertise to your clients. This is the area. And like I say, we're going to focus on the best opportunities. Some of these spins are just duds, and they're not even worth looking at. So again, we'll play up with the best ones for you. All right, good. So I'm going to hand you on to Jonathan now. Jonathan's I've seen the deals analyst. He's been with us, and I keep getting this wrong. He's been with us over 14 years. He keeps checking me on it. If he checks up me again, that's it. But he's a great guy. He's the guy you will speak to. He's the guy who will play up the ideas for you. You come to him. He'll direct you according to your criteria. This is very important. Like a lot of you guys on there will be value guys. Hey, Jim, don't show me biotech. Don't show me, macro opportunities. Well, we won't. So out of that pool of good ideas, we'll refine it more to hit you with the great ideas, saving you time, saving you effort, but also playing you up some great opportunities. So John's the man on that. So I'm going to hand on to him because he's going to take you through how we do things, and hopefully that's give you some interest. But feel free to reach out for me and ask me any questions, and we can chat some more. Thank you.
Great, appreciate that, Jim. Thanks for that. So yes, as Jim mentioned, I've been with the team since 2010, so going on 15 years now. And my role at the Edge is not only finding the ideas and going through the research and knowing what's a great idea versus a bad idea, but also mainly speaking to all of our clients, so like yourselves, on a weekly, bi-weekly. To be honest, some of the big guys just want to call once a month. But it's just to plate them up with enough information on an idea so they can go away and do their own due diligence. So, we like to say we played up 70% of the idea, and you go away and do the other 30%, and hopefully we have a home run of an idea. So over the next 20 minutes, 25 minutes or so, I'll run through that process and how we plate up and vet these situations, because Jim mentioned it a number of times. Some of these spins are duds, and our data actually says that as well. And that moves smoothly into what does our data show, because who cares what we think at the end of the day? Is this the right sector we should be looking at? Is this the right market cap? Is it even the right timing to look at spins? Because there are cycles when you could buy a basket of all spins and make money, and then there are opportunities where they fall off a cliff, but maybe there's an opportunity to buy at a much lower level. So we have close to 25 years of spin-off data, going back since 2000. And around 70% of those are US spins, but we've broken it up US and Europe. And it's been a resounding, outperformance of spin-offs. So spin-offs in general, they outperform their parent companies and the market over time. So often there are a lot of questions around the corporate breakups at which part of the transaction performed better. the parent who spins off that division, or is it the spun off entity or the spinco in this case? But yes, the data does show that there's a resounding upside, especially from a 1-2 year position. So if you're a longer term investor, spinoffs win in general, given around a 25% return after 2 years. We'll go into a little bit more. So what does the data show? So again, going into a little bit more of the nitty gritty from a 1 month, 3 month, 6 month, 1 year, and a 2 year perspective. As you can see with the parent companies at the top, there is there is not a lot of outperformance. You can see they're in line with some of the indexes, whereas if you go down to the spincos, on average, from a 1 year and a 2 year perspective, that's where you see those generating alpha, as Jim mentioned. But what's interesting, what I will say, is that that is starting to turn a little bit. The tide is starting to turn, and I'll save a reason towards the end of the presentation as to why and what we're seeing at the moment in the market. So I guess the question is, okay, so when we do have a spinoff announced, as Jim highlighted, so we'll go through the filings, it's been announced, we alert our clients to say, okay, great, we found a spinoff. What do we need to look for? What is our checklist when we go through that situation? And it's a number of things, but it's very important to us. So when we're analyzing the parent and the spinco, how healthy is the finance of the business and the spinoff and how it reshapes. The rationale, I guess maybe that should have been first. That's the first thing we look for. But it is the first thing, because spinoff rationale is why they're even pursuing it. What's the meaning behind that? Are they just trying to spin off a low growth, low margin asset, put a lot of debt on the spinco so that the remainco can thrive going forward, or are they actually spinning off a great asset to shareholders? So we do the evaluation of the spinoff entity. Like I said, we're using that data that we have as well to figure out, does this fit in the right bucket for us when it comes to a good idea or not? We take a look to see how the market reaction is as well. So if the announcement of the spinoff happens, does it jump 15% or 10% on the day, or does it actually go down? Maybe shareholders don't want this thing broken up. Valuation metrics, so applying industry appropriate valuation methods to the spinoff, of course. Management and governance, who's running the show? Have they done a spinoff in the past? Could they potentially be another successful spinoff under their belt? So we look for that. We do, like Jim said, break up the analysis, fundamentals, technicals, and insiders. The financial restructuring side of things, so examining the debt distribution. As mentioned, sometimes it just lists a load of leverage onto the spinco, and then it comes out 3-4 times levered, sometimes even more, and usually that's a recipe for failure for most spins. Regulatory and legal considerations, so any hurdles, tax implications, is it tax-free, is it taxable spin, anything that should be highlighted within the report. Industry outlook, so we look to analyze the spin-off industry for growth trends and potential disruptions. And of course, our post-spin plans, or looking at the post-spin plans, I would say, which is investigating the spin-off strategic goals and expanding opportunities post-breakup. And at the same time, we listen to what management says with a pinch of salt. We don't speak to management. We do our own independent research when it comes to these spins. So we're not in cahoots, if you will, with management and getting pitched a really great story to say, hey, you should be looking at this situation. But let's go to maybe a live a couple case studies which did very well for our clients. One that maybe you guys did get involved in, ESAB Corp. It's funny. A client asked me earlier this week. He said, "Hey, Jonathan, do you have another ESAB type of situation?" Because it was a great returner. And some of the reasons behind that, again, data-driven. We had a track record with the Rails brothers. So this was Colfax first, split into two: the medtech side, Innovis, and then the fabrication technology side, which was ESAB. And we found out, and this was based on the Rails brothers track record with regards to, like I said, Danaher. Danaher has done a number of spins. And what we found out is when we looked at the 4 or 5 distributions that they did, when the Rails brothers invested their own money in a particular stock, that usually did very well. So Danaher was one, ESAB was one, and a more recent one, Veralto. That was another one. But this one we recommended pre-spin. This was a high conviction name. We liked the setup of the spin as well because it was kind of it was a kind of low leverage situation. Mitch Rails became the chairman. There was some insider buying ahead of the spin, and the value unlocking opportunity for both situations looked very enticing. So we recommended clients to get in. As you can see, it started off, it went up to 60, it came back down, and then the rest, as they say, is history. It listed at $50 a share. Stock's now at 130. Over that same period, the S&P is up 35%. So you can see that alpha creation or alpha generation from the spinoff side, because this was the SpinCo. Innovis was renamed as the parent co. As Jim mentioned, we're not running money, so our goal is to get these type of ideas for you. And if you do the work, well, you will do the work, but if you see more upside than us, fantastic. That's what we want. We want you to get that 100% gainer or even more, like a lot of our clients did for ESAB. Another one, Finia. This was one I personally liked. I love the setup of this situation. The details around it just made sense. And I was banging the table for anyone who would listen to me to get involved in this situation. So this was a spinoff from Bulk Warner last year, actually. It was spun off on July the 5th. Yes, July the 5th, the day after July the 4th. So you can imagine everyone was in office on that day itself. But we did our analysis, looked at the space it was in. We found out that it had a much lower leverage than its peers, which is a good sign. We like to see when spins don't have a lot of leverage. It was a good free cash flow yield company at the time, I think it was around 13%. Reasonable margin profile. They were guiding for dividends. Everything looked set up for this to do well. And as you can see, there was some misrepresentation on the index play. So this is where the technicals for us come into play. It actually entered the S&P 500 on day one, so July the 5th. And then the next day, it got kicked out. So you can follow that on the S&P website. But as a result, over the next few days or so, it was down like 24%. So all of a sudden, you had this 30 plus 35% discount to its peers when leverage was better than their peers, the free cash flow was better than its peers, the margins were in line or if not better. And all it did, and then there was insiders buying around that level, as you can see there. And then we had our first analyst coverage, because that first through 3 months, 2 to 3 months, no one was covering this stock. And then finally, we got another coverage almost a year later, 9 months down the road, of finally looking at the stock. And they announced a dividend, which was close to 3%. They announced a share buyback. So it stayed range bound for quite some time. And then that second analyst, which was Morgan Stanley, they put a $50 target price when it was still trading in the high 20s. What's happened with this stock? I mean, you can pull it up. We recommend around 29. It's up over $50 right now. Like I said, a huge outperformer, which is what we're looking for. So those are the type of situations we like, mid cap and large cap as well. And there are also some small cap names that come through the pipe. But of course, everyone's going to say, great, well, all spins work, but Jim, has already said that not all spins work, and actually our study should suggest that. So some of the breakups that did not work, they never want to tell you the ones that didn't work. And again, you may have seen some of these before with AOL and Time Warner. That was a struggling, digital landscape at the time, decline in revenues, and eventually it was AOL was eventually acquired, take under, if you will, far less from the peak of its valuation. Sears was not another one, but not a great situation where there was some decline in value in the properties of Sears stores. So it was just difficult times and underperformance at that point as well. Viacom with CBS, that was not a great situation that went through either. Alcor and Arconic initially wasn't great, but what we also do as well, a lot of we talk about a lot of forward thinking and what's coming up, but we also hunt for some of these ideas that are not on everyone's screen at the moment and not a Finia, because it's not covered by the street for the first 3 to 6 months. And there are really great opportunities here. And in fact, Arconic was one of those names that we picked up actually 2 years later. We saw some value in the stock. We knew there was a potential takeover play before the breakup even happened, and we predicted it pretty well actually. And we said this was a good takeover play, and actually a month or two later, that situation happened. But initially, not a great spin to get in initially, and even a more recent another one, Cerence, was spun off from Nuance Communications. Nuance was a great spin. The parent company did very well. It was taken out eventually. And Cerence, CRNC, I went from close to $90 now down. It went all the way down to $3. It's had a little rebound recently. It's back up to 9, but I think new CEO at Intel has moved over there. But yeah, that one you didn't want to hold on from day one, but now there could be an opportunity. So that we're looking for some of these fallen and forgotten spins as well, and you will have access to all of that intel and those situations that went through. So again, we've highlighted a few names that have gone through, that were positive, and then a few that went through negative. So how do we distinguish? In fact, forget how do we distinguish, because we've highlighted some of the checklists, but have we distinguished? Not getting into some of the not so great situations. And to be honest, over the last 5-6 years, we have recommended maybe less than half of all of the situations that have gone through. The edge buy recommendations. When we like a situation, we recommend pre-spin, because there's a way to play both the parent and the spin co by having that in your portfolio. And then also we do some recommendations post-spin as well if we really think there's an opportunity there, but probably more pre-spin than post, as you can see. And our recommendations at this time have outperformed the S&P, which the S&P, as we saw in earlier slides, has been doing very well. So there is outperformance there. And granted, this performance doesn't include that same 100% return on ESAB or 160% return on Finia, because we look to get out of this situation, collect our 50, 60, 60% return. Thank you very much. Nobody's going to fire you from making a return. But we move on to the next situation, because there's so many situations. And our goal, as Jim mentioned, we're not in your position of running money. If we do, then that's a different story. But we're here to create ideas for you and look for those type of situations. So, but yes, we don't want to burn you on the bad ones. And some of the best sectors we recommended: industrials, we're pretty good at; real estate, healthcare. More recently, we've been very good at utilities, because we found out that some of the best performing, if not the best performing sector, would you believe it, is the utility space. And one of our more recent spins in that space that we highlighted was MDU Resources. Reach out for us if you want to see the analysis there. And we're also on the flip side protecting clients that to not get involved in the rest of the deal flow. So on average, these companies that we did not recommend, they're up 2% versus the same 14% from the S&P from a 1 year perspective. So again, we're looking to try and stick to our core, our checklist to find the better names. And we're not afraid if one or two go through and maybe they've run away from us, but at least again, we're not burning you on the bad ones. So again, the edge process, a proven result. As Jim mentioned, we've been doing this for quite some time. You can see the average returns there. As mentioned, pre-spin recommendations seem to be doing doing us a big favor. So that's where we're at in these kind of situations. So again, on average, we're hunting in the right area. And I would say most of our clients spins and special sits are maybe 20-30% of their book. So it's not the full 100%. They're only doing spin-offs. They want that little extra alpha within their portfolio as well, and a bit of a diversification as well. So I mentioned earlier that spin-offs in general, over our 20-25 years of data, they're the ones that are outperforming the market. Now, there are pockets within that time frame where the parent company actually outperforms, and that time frame has been this year, and we've been guiding our clients pretty heavily on that. I'm probably a broken record to them at this point, but we have been seeing a greater outperformance of the parent companies. So here's a few names that have gone through globally, US, with 3M, GE, obviously Jim mentioned, Howard Hughes, Jacobs, MDU, I just mentioned that, TC Energy in Canada, Berry, which was just a recent one as well, Liberty Global. All of those, if you just bought a basket of just parent companies, I mean, okay, 14%, but the market over that same period, so that weighted period, it's only up 7%. So I say only, it's the alpha there is, you can see the alpha generation is more on the parent companies this year. So even with a few stragglers in there from Australia and one real estate spin here in the US, again, you're still outperforming the market. So why have the parent companies right now outperforming the spins and the market? I mean, right now we are seeing a bit of a strategic change when it comes to spinoffs and the spinoff announcements. We have been seeing a lot more companies announcing. So even Honeywell with Garrett Motion and Residio, they're on the cards to do another breakup next year. But we are seeing more companies announcing spins out of duress or spinning off the lower margin, lower growth business than before, than say 3-4 years ago. So right now, what we're telling our clients is if you are looking to get involved with a company or a spinoff in this case, or you do have one in your portfolio that's coming up, pay close attention to the parent company, at least over the next 3 to 6 months, because that's where you're going to get the outperformance and the alpha that you're looking for. There are going to be some good spins, and that's where we're going to have to figure out on your behalf. That's our job, but we have to be much more picky and choose carefully, especially in this market. But not all spins are bad, but right now you're not buying a basket of all spins. So upcoming breakups for later this year. I mean, we're only a few weeks away from the end of the year, but going on to 2025. I mean, we have close to 26 breakups with another 20 on the calendar as potential. So companies that are deciding, do we spin off the asset? Do we sell the asset? Do we do nothing? But they've announced a strategic change. So that 26 could be 35, 40, by the time we end 2025. And remember, if 26 seems like a little bit, but once you split them into 2 or 3, and no, we didn't make a mistake. There are some 3-way splits in there as well. So it's not 26 by 2, you will see a lot more situations coming through. So at the moment, the split is more like 12 in the US. It's almost like a 50-50 split. And you can see here, right now, as we speak today, it's almost a 50-50 US versus Europe and the rest of the world. That might change in the next few months where maybe a few global situations don't go through and they fall off the calendar. We've seen that before, but interestingly enough, even though we began the year heavily weighted on the US side, we are seeing more European situations coming through as well. So our pipeline is continually growing with these new announcements. And as soon as they come out, you guys are alerted. Our clients are, I would say, are alerted once they go through. But once we get all the details closer to the situation, that's where we really give our intel on these spins. But interesting pipeline, as you can see, it varies from any sector. So if you're a sector specialist or you're generalist, then you are going to see some situations in their respective fields. So I mean, even on Monday, we're looking at Vivendi, as Jim mentioned, the four-way split. We've already done our due diligence on that. We've highlighted to what we think is the best play for that to our clients. That's like the John Malone in France. Vivendi doing Universal what was it, a few years ago, and with Bill Ackman involved, etc. So there's a lot of situations, but again, we're not only just focused on that 26. There's still going to be some we're looking backwards for. So it's names that spun off 3, 6, 9 months ago. There are opportunities, and there's like 3 or 4 that we're going through right now as we speak. So we're coming to the end here. I think we're good for time. But just to recap, like I said, what we're trying to do on our end from an independent firm like ourselves, we're looking where others are not, and or most aren't, I should say, and that's in the spin-off space. And even a lot of the screens that some of the big screens out there, they don't pick up some of these spins initially in the first 3, 6, 9, even 12 months. And that could, cost an opportunity to find the FINIA, ESAB, or other type of situations as well. So, we're looking for that analytical but behavioral edge as well. And, just knowing what we own and doing the best to our ability. But if you have any questions, and I'm going to bring Jim in now as well. But yeah, I mean, definitely come to us. You reach out to Jim, jo@edcgroup.com. We'll do a little bit of the Q&A. I think there's a few questions that have come through. And next steps, I mean, if we want to help tailor your insight, let's schedule a meeting. Let's let myself and Jim give you a heads up of what's going on and what's happening. So that can all be set up through Paul as well. But hopefully that was helpful to you guys. I'll put Jim back on the screen. But yeah, that's how we're looking at the space and adding value to our clients.
Great. Thanks, Sean. Thanks for that. I hope you enjoyed that. A little bit of insight into what we do, how we do it, and obviously, the value we're going to provide to you if you come on as a client. Just a couple of, if you have any questions, put them up now. I'll answer a few that's come through. One of them said, what's the immediate operational challenges you anticipate for the spin-off in its early days? It's a great question because, spin-offs, they're frequently looked at as the garbage or the garbage of the business, and they sort of are to begin with. It's let's take Honeywell for example. I mentioned that earlier. Honeywell dumps $1 billion of debt blindly on their spin-offs, and they nearly went under. If you look at Residio, REZI is a ticker, REZI. There's a classic case of just nearly buckling under the weight. I mean, that reached a low of $3.50. Today it's at 27. Now, what's interesting is in the analysis when we look at these sort of early spins is how much debt they got, what can they take, who are the management, how they're going to refinance it, because they're going to have to. And frequently, when we see great management, they can do a lot of this. And great management will pull companies around, and they can turn out to be fantastic investments. And Resilio, if you got that down there, you'll be very, very happy. So there comes a point where stuff like that. And I'm not sure John showed on the chart there, but another one that everyone was, I think a lot of people were familiar with was Enlop. NLOP is a ticker, NLOP. Now that started off life, spun off $50. The next stop was $9. Now it was just an index selling situation, and at $9, it was 40% of net asset value. And we just thought that it was a great opportunity. A month later, we got clients in it about 10, 10 and a half. A month later, we were selling it at 22, 23. So, there's plenty, like I said before, we're trying to find out what is the edge? What is the edge in the situation? So early days of spin-offs, they can, have a number of problems because they're designed to be spun off because they have problems. Our job, and your job as an investor, is to figure out, can they solve that problem? Because not many go to zero. In the first 6 months where there's no coverage, there can be a lot happening behind the scenes. If you imagine someone's giving you a bad business and you're an entrepreneurial mindset or even an analytical mindset, and you're thinking, you know what, how do I turn this around? You're going to try your best to do it, especially if you've got stock options. And you combine an entrepreneurial mindset with a smart guy and stock options above where the stock price is. There's a recipe there for at least giving it a go. So, that's some of the operational challenges, but Residio is a great example of that. And there's plenty of those early on. It might just be the best opportunity to buy the spin-off straight off the bat. And like I said, like John says, parents this year performed very, very well. So, if you're looking at spin-offs this year, there were some good ones, but, maybe you're looking in the wrong place. But we'll direct you on that. So, someone else said, what was the other one? What I've just got two screens here. How do spin-offs generally perform compared to market cycles? Like I said before, they are consistently a source of good value over any economic environment. Now, people have heard me say this before, but we've got a lot of spin-offs on the calendar at the moment. I think there's a lot. I don't know what John says, but they're more by the day, but 25, 30 plus. It's a lot come at the top of the markets because valuations fall, but a lot come at the bottom of markets because people want to get rid of the bad stuff at the bottom. And buying bad stuff when people are selling is great, and selling stuff when people really want it is great too. So I think we're sort of come to that stage, but the point is that over that cycle, there are many situations where we're independent of the market. And if you look at Residio again, just to keep on that example, there's no market correlation there. So if you're looking for a book of some non-correlation in there that you can shout to your investors and say, look at how great we are. Definitely, the space is one to look at.
And I would add to that, Jim. I mean, it's an inefficient way of distributing shares. So you get the shares whether you like it or not. So as an investor, do I still want to hold on to these shares? If I'm an index fund that can only hold S&P 500 stocks, and I get a mid cap or a small cap name, can I even hold it? Is it my mandate to even hold the name? So I agree. It kind of varies, cycle agnostic, if you will. It just varies on each and every situation, and it depends. Sometimes you're going to be buying all the spins and they will do well, or you just wait 6 months, pick them up at 20-30% discount to its peers, and make a massive return over a 1 to 2 year period.
Mhm. No, someone else put in, who leads the spin-off and what successes or failures have you seen in that respect? I mean, great question. I mean, spin-offs are still, with all this AI and technology around, companies are still people businesses, and they get driven by their entrepreneurship, their ability to, their skill, and all this sort of stuff. but also their actions speak louder than their words. And I hinted before, we have about 40 years of data in terms of looking at who are good insiders. And as John said before, and the Rails brothers, Danaher, if you know the company Danaher, I'm sure you do, the Rails brothers has a number of spin-offs. And what we spotted in that was not only a good company in Veralto, VLTO is the ticker, they got spun off, but we noticed that they only took positions in 3 of those spins. So multiple spin-offs, but actually they took a position in that spin, and then they took a position post-spin in the company. So which suggests to us, yeah, it's one of the better business, and it went from 70 to 100 115, 120. So it's very important that you look at the management, and I think that's one of my biggest edges in terms of looking, are these people good? Have they been good in the past? What are they driven by? And a lot of management are not really driven by incentives. It's the same with selling stock. Everyone sells stock. We all sell stock because things go up. Does that mean we're bearish on a stock? Of course it doesn't. And it's the same with insiders. They sell stock because they want to buy something and they want to realize some profit. When they buy stock, that's very interesting. When they put their money in their pockets and they go and buy stock in the market, then that's something completely different. And if they've been good in the past of doing that, and if there's a group of them doing that, then coupled with the fundamentals of the stock, could be a very, very good name. So management are key, really, when you look at spin-offs, and the ability to turn around crap businesses as sometimes they're spun off as, is very, very important if you're going to look at these things. Let's just take one more here. European spins are interesting. Yeah, go on, John.
Oh no, I was going to say, what's your best idea right now? That's interesting.
My best.
All in.
Don't ever put me on the spot, John. Yeah, my best idea. I mean, look, listen, I'm coming fresh off Boeing, right? That's still my best idea. Boeing, again, I spoke to this earlier. We thought we felt a need to, I think the company was in dire straits. GE had separated similar businesses in the past, and we had done the analysis. The breakup value is double what it is now. Pretty much. We got into the clients in at, bit early, about 140s, and then we got them in again at just 139. And, we wrote to the company, the letters on the internet, Barron's covered it, but you have a duty as a shareholder to push that. And our idea was that, the margin of safety of that is great because the valuation is so cheap. Now, if they do anything to turn that around, or if they change any debt, or if they make any changes, or if they even break up, then there's huge upside. And what they did in the past 2 weeks, since we recommended it, stocks up 20%, is the fact that they said, we're gonna lay off, we're gonna streamline some workers. The 737's back on the production line. We recognise there's a problem, and even that, has pushed the stock up. So if there's any, which I believe, there's more changes coming. There's significant upside in this stock, and it won't fail. And famous last words, but I don't believe that will. So yeah, that's my best idea at the moment, and I hold it. And I say to everyone, look, if we recommend the stock, I would take a position as well because we eat what we cook. And I want to be passionate about making money with you as well. Why shouldn't we be?
Yeah, and I would say let's set up a call because what might be a great idea for us is not something for yourself, whether it be market cap size or sector wise or so forth. And that's the beauty of it. The spins, we're generalists. We're going to cover them wherever they come. But we are, I will say, working on a few big names. I mean, yes, we mentioned Vivendi. That's already done. I mean, the activists tried to kill it. It's going through. They confirmed it this week, but we're actually working on 2 or 3 names that I think are going to be really good and interesting situations that we're working on. So keeping a little bit towards our chest, if you will, and for our clients. But I mean, let's set up a call, and we're happy to go through your criteria, what you like to look for, and even look further down the line to see if there's something on the calendar that'll be worth your while. But yeah, that's what I would say as well.
Fantastic. Thanks, John. All right, guys. Thanks very much. We stuck to the hour. Hope we didn't stretch your time too much, but hopefully it's value to you and it was interesting. And like John says, check us in. I'm sure Paul was going to follow up on each and every one of you. And yeah, hope you enjoyed yourselves. Thank you very, very much.